Hey, what's up, guys? It's Ezekiel here. So, I ask you, how many times have you entered a breakout trade thinking this is the one? This breakout is going to shoot up, but only to watch price reverse, stops you out, and then shoots off without you. It's like, right? So, the problem is most traders don't actually understand how breakout works. They chase the move, enter at the worst possible time, or they trade against the trend, and then they blame the market for being manipulated. Today, I'm going to change all of that for you. I will show you exactly why certain breakouts fail, the traps that the smart money sets for retail traders, and how to only enter breakouts that are real. So this is a complete masterclass on breakouts that will teach you everything that you need to know on how to be successful in trading breakouts. What is a breakout, right? So a breakout happens when price smashes through a key level. So either a strong ceiling, which is the resistance, right? Or a solid floor, and that is the support. So when that happens, momentum kicks in, right? And price can explode in one direction. But here's the deal. Not every breakout is real, right? So some are fake moves that are designed to trap traders, right? While there are others that can lead to massive trends. The key is knowing the difference, right? So how do you spot breakouts that actually matter, right? It all comes down to breakout patterns, clear setups that shows you when the market are primed for the actual move. All right, so now before we go deeper on that, I'm going to talk about the 3 common mistakes that traders make when trading breakouts. You see, there is a big one, a big green candle that is blasting higher, right? And then what? Your first thought is, ooh, this move, this thing is unstoppable. I need to get in now. But hold on, ask yourself this first. If it was really that easy, wouldn't like everyone be rich, right? So that big move is often just the smart money that are unloading their positions, while the retail traders, they come in late. So the market isn't telling you to buy, it is like baiting you. So instead of chasing, take a step back. Strong moves needs a breather. Wait for the pullback. So you can let the amateurs get trapped, and then you strike when the odds are in your favor. What is stopping you from buying? Now think about it. When the market shoots, it doesn't just keep going, right? It needs to catch its breath. So a big breakout candle often means what? Price is overstretched, right? And when that happens, a pullback or a reversal is around the corner, right? So if you jump in right now, you are not trading, you are chasing, right? And chasing, it puts you in the worst possible. Next, entering immediately after a breakout is also a gamble, right? There is no confirmation, there is no follow through. You are just hoping. Hoping is not a strategy, right? So before you hit the buy button, you gotta ask yourself, am I entering at a smart level? Or is this just reacting? Or is this just FOMO, right? Fear of missing out. Say you enter the trade. Let me ask you, where would you put your stop loss? So chances are you will just place it where? Just below this low, right? If you look at the chart on the left, right, you will notice that this area used to be the resistance, right? But now it acts as a support, right? So now, if you set your stop loss just below this low, what's going to happen is price might dip to test this support, right? High chance, and then bounce back up. So, but what it will also do is it will stop you out because your stop loss is too close to the support level. All right, so now you may say like, okay, then I'll just place my stop loss a bit lower, below another low point. Let's say you're entering at this point, but your stop loss is like, whoa, 50, 100, 200 pips away. You are giving the market the free pass to wreck your trade, right? A stop entry to your stop that wide for starters is going to what? Kill your risk to reward ratio, which means what? You're risking too much to potentially getting too little, right? And why? Because you chase the breakout, right? So the market, it loves trapping breakout traders. Price explode, it lures the traders to go in there, right? And then boom, it snaps back, right? Stopping you out, right? Or leaving you in a really bad position right at the high, right? So So the solution, stop chasing. Let the price pull back, wait for a build up, which I will explain more later, right? And then enter where your risk makes sense. Your risk to reward should make sense. Okay? Now, here's another example of you or anybody chasing a breakout. And that's why you should not do it. So, if you take a look at this chart, price drop pretty much in just a few weeks and it's looking bearish. So many traders, they expect price to drop further after breaking a key support level, right? So it's like, oh, this seems like a good time for us to sell. So if you had chased the market there, it's going to be painful. Price, what happened? Price reversed and shot back up to the highs, right? So this proves that chasing the breakouts failed again in this example. So look at how bearish it is, right? So most people, they sell, right, as price broke below the low, right? The market picked you and then it shot back up higher. So now there are two things to remember. Okay, number one, breakouts doesn't always means that it's going to follow through, all right? Price can pull back, trap traders, and even reverse, right? Number two, if there is no clear stop loss level, you are exposed to a massive reversal. A breakdown, say you're trading a breakdown with no near swing high for you to place your stop loss, then that becomes a very wide risky stop, which will lead to a bad risk to reward. Right? So the bottom line is that if the setup doesn't give you a logical place to manage your risk, a logical place to put your stop loss, skip it. Rule of the thumb, protect your capital first. Don't chase your trades ever. If you see the example here, the nearest swing high is all the way up there. And if logical sense, because there's no previous swing high, that's the only one. If you're going to enter right at the bottom, that is going to be a wide stop loss right at the top. Rule number one is going to be simple. Do not chase breakouts ever. All right? So there will be times when you are thinking of buying a breakout against the trend. That is asking for trouble, right? So think about it. If let's say there's a river, right? There's a river. The river is flowing south. Would you want to swim against it? Of course not, right? But yet traders do that all the time. If the market is in an uptrend, breakouts that are going upwards have momentum behind them. And if it's in a downtrend, breakouts that are going downwards have the edge. But if you go in the wrong way, that's like you are going against oncoming traffic. It's going to be really painful and unavoidable, right? So trade in line with the flow, not against it. So if price is making lower highs, it is a clear downtrend. Do not fight the downtrend. In a downtrend, you should look for selling opportunities. If price breaks above a high point, like this swing high here, right? You'll be like, should you trade the break? No. It is still usually wiser to stick with selling. You should generally not buy during a downtrend because the market is heading down. In an uptrend, should you buy or should you sell? Buy, right? But hey, if you see, most traders spot, they spot now this head and shoulders pattern, right? And they instantly think, head and shoulders, it's time to sell, right? But that's where they go wrong. Patterns doesn't matter if you ignore the broader, bigger picture. So before making a move, check the trend first. If the trend is in an uptrend, why are you looking to sell? A strong trend would supersede a chart pattern every time. So instead of fighting the momentum, we should be looking for buying opportunities. Even if the break downwards in this head and shoulders looks like really convincing. Trade in line with the trend, not against it. To add on, breakouts with tiny range, maybe about 20 to 30 candles, right? They do not have enough power in them, enough momentum in them, right? They are weak and they can fade off. So if there are no build up, which I'll expand more later, and the market hasn't coiled long enough, that breakout is going to be likely to fail. So there are two mistakes that can wreck your trade. Number one, chasing breakouts. So when you're FOMO, it's going up, I better get in just before it shoots up all the way. No, that's FOMO, right? It's going to get you trapped over there. Number two, buying breakouts against the trend. That's where you're fighting against the momentum, and the momentum always wins. If you want better success, be patient, you wait for a build up and trade in the direction of strength. Let me show you a breakout strategy that works, which is what? A breakout with a build up, right? So here's the thing. Most breakout fails because why? There is no real pressure behind it. The market is not ready to move yet. So instead of jumping in blindly, wait for the market to coil up first. Let it build the pressure before put them, right? So here's the thing. I look for a range that lasts at least 80 candles, 80 bars, 80 candles, right? Why? Because the longer price stays trapped, the more explosive the breakout is going to be. So it's like you're stretching the rubber band. The more the tension, the harder it snaps. Once that build up forms near the resistance level, that is your signal, right? Not when the price is still bouncing around, but when it's hugging that breakout point, when it's hugging that breakout point and getting ready to launch. So this is how you stop chasing breakouts that just moves and you start trading with precision. You know exactly when to enter for a real move, right? So now let's break it down further. Why 80 candles? I mean, it doesn't need to be exactly 80, right? It could be 75, it could be 79. It's fine, but 80 is like a general guideline, because the idea is that the longer the market stays in the range, the stronger the breakout is going to be after which. Let me show you behind the scenes of what is kind of happening. It's all about the pressure. The market is like a pressure cooker. The longer the price stays trapped in the range, the more the orders are stacking up on both sides. The buyers above and the sellers below, right? So every attempt of breaking out, it fuels the build up even more, right? So when the market finally escapes, it is not going to be a slow move. It is going to be an explosion, all right? So now let's go deeper. How do traders place their stop loss inside a range? So for example, if someone is selling at the resistance level, where are they going to put their stop loss? They're usually going to put their stop loss just above the high, right? Correct? Like this. If price drops to the bottom of the range, what does most people do? They're going to buy at the support level, right? And they probably are going to set their stop loss below the lowest point. So the longer price stays in the range, the more the tension is going to build. It's like a spring, it's getting tighter and tighter and tighter. Traders, they start adding all the selling positions at the resistance level, place their stop loss just above, right? That creating a wall of a lot of buy orders, right? When the breakout finally happens, all these stops are going to get triggered. When all these stops get triggered, it fuels the explosive moves even more, right? So this is not like, ooh, why did the breakout become so powerful? No, it's because of the pressure being built up, because of lots of orders, lots of stop loss orders over there. What happens when you have stop loss orders? Stop loss orders means what? The orders get, when one goes off, the buyers comes in. When people start selling, people start buying. And that's why the move becomes explosive, right? So the longer the market stays trapped, the bigger the breakout is going to be. But here's the key. Not all breakouts are worth trading. The best ones, they come after a tight consolidation, which is a build up near the breaking point, right? When there's no build up, it's going to be a weak move, right? With a build up, you are looking at a breakout with real momentum. So chasing breakouts, which is what we talked about earlier, is going to put you in a tough spot. Why? Because where would you place your stop loss, right? If you place it too tight, too close to the breakouts at a high, it's going to get you stop out, right? In a fake move when it reverses. When you place it too wide, like unnecessary risk to a small reward, correct? So the smarter move is to let the market do its work first. If price consolidates, dips, and then break out, that's where we got the structure, right? Market structure. You can then place your stop loss below the support level where it makes sense. So, but as you can see, if you trade in a normal way, your stop loss would be what? Too wide, right? So instead, you wait for the build up, in which price rises and then what? It holds steady near the top rather than it drops back to the support. So when you hold steady near the top of the breaking point, this gives you a clear spot to set your stop loss. All right, so now you can use this swing low to set your stop loss now. Your stop loss here is going to be much tighter, set in between the highs and the lows over there. That is going to be your stop loss. If before there has not been a build up for the stop loss would have been what? From this low itself. So a wide stop loss, like I mentioned, is going to kill your risk to reward ratio. That's why we wait for the build up before entering the trade. And it's not just a better risk to reward ratio. You make way more money. And it's not just making way more money, because this build-up increases the probability of this breakout becoming an explosive move itself. All right, so now here's the add-on. You can also add a 20-period moving average. All right, now instead of to time the market. So now instead of you jumping too early before it actually explodes, you let price consolidate near the breakout point, and then you watch for the 20-period moving average to catch up to the lows of the build-up. Okay, so now why? When price holds steady and the 20-period moving average closes the gap, it signals the momentum is building, and this is a breakout with real strength. Patience is going to pay off here. Number one, you got a tech stop. Number two, you got a better entry, and then that's getting squeezed out for a higher probability trade. Right? So but don't jump in yet. You wait for the 20-period moving average to touch the lows. That is your signal. Right? So when it touches the lows of the build up, that is your signal that when the market might probably going to start moving. All right, so let me give some examples to make this easier to understand. All right, take a look at this. All right, so if you look at the candles from the end to the end, right, to measure the range, you're gonna see it's about what? 80 candles, 80 bars. All right, so now first off, it qualifies. This range, it qualifies to potentially be a real breakout. Yeah. Okay, so now if it's below, don't even bother. All right, so now it qualifies. So first criteria, check. So next, we wait for and we are looking for a build up. So this is the build up that is being created, right? So you spot the build up forming. It looks promising. But then where or when should you pull the trigger, right, for your entry? That's where the 20-period moving average comes in. So it's not just a moving average. It's like your traffic light. It's now ding, green light, right? So if the lows of the build up have not touched the 20-period moving average yet, the market is not ready to take off. The breakout might be weak, or even worse, if it breaks out, it could be a trap, right? So you gotta be patient here, right? You let the 20-period moving average catch up. It confirms the momentum, right? And then you strike. So this is how you avoid false breakouts, right? And you get in when the market is primed for the move. If it's too soon and you set your stop loss or your buy stop order above this high, it's gonna be too soon, right? You wait, right? Because there could be false breaks over there. You wait for price to touch the 20-period moving average first, right? And then you get ready. So here's how you enter. You place a buy stop above the highs. All right. So once the breakout, this setup is in place, you don't just, I'm going to go in right now. No. We place a buy stop order above the highs. You let the market comes to you. Or you can wait for price to eventually close above the breakout level with a good solid green bar, right? As a confirmation. Here's an important thing. Where should you place your stop loss now? All right. That is easy, right? You should probably already know, right? Which is what we talk about. Below the lowest point of the build up. Why? If the market was really strong, it should not dip back below that level. If it does, that breakout is weak and you do not want to be in that trade anymore, right? So this way, you're protecting yourself while giving the trade enough room to play out. Right, so you're going to get yourself a very smart risk with a very strong setup. So now, let me give you a pro tip. So when you are trading, should you be trading with the trend, right? And when you're trading with the trend, you do not need a huge build up. That build up, about 40 to 50 candles are enough. Why? Because you are in line with the trend. That build up is good enough because it comes with momentum on your side itself. But if you're trading against the trend, you're going to need more confirmation. That is where you need at least 80 candles, right? To make sure that the buyers and sellers are serious in that direction, whichever direction that is going to hit to. All right? Patience is always the key in trading. When you're rushing for breakouts, it's going to fail. You stick to the setup, you wait for the build up, and only strike when all the odds are in your favor. Right? If a trading pair is breaking into an all-time highs, you want to pay attention, right? So like for example, whether you're trading gold, whether you're trading the S&P, or whether you're trading a certain currency pair or certain crypto pairs, for example, when it's making high highs that it has not reached before historically, that's where you want to pay attention, because this is where momentum can explode. Okay, why? Because there are no resistance above, none at all. It's heading into uncharted territory. There is nothing to hold it back, because everybody that are already in the trade are winning. So there is no reason for them to sell. When there are no sellers, there are lesser pressure. When there are lesser pressure, it means higher prices. So it's like a clear open highway. There are no roadblocks, just momentum pushing the price higher. Alright, so but here's the key. Not all breakouts are equal. The strongest one, it comes after a build up. Alright, not like a random spike. So when price grinds higher, it consolidates and then breaks out, that is a setup which is worth trading. Alright, for example, this is a good sign. Most traders, they see all-time highs. Oh, they panic. It's too high right now, it's too expensive right now, it has to drop. When a trading pair, it breaks into a new high with a strong build up, it is not weakness, it is pure strength. There is no overhead resistance anymore. There are no trap sellers. There are only momentum, right? This is no longer like, oh, FOMO, fear of missing out, let's get in. No. This is now a calculated move, right? The smart traders recognize when the breakout is backed by an actual build up and volume, right? This is when you strike. All right, so now here's a good spot to set your stop loss, which is what you already know, right? Just below the lows of the build up, right? So now let me give you another example. So earlier we looked at what? A trend continuation breakout, right? Where the market was already moving up, right? And the breakout just kept the momentum going, right? So because it's hitting the all-time highs. But this one is different, right? In this example, this is a what? This is a reversal breakout, right? So reversal breakout means what? Remember the tip that I gave you earlier. The market needs to be in the range for at least 80 candles. So, and in this case, is in the range for at least 80 candles. So it means what? The pressure has been building, right? On top of that, there is now a clear build up, which is a tight consolidation that is near the breakout point. All right, so that's the key. Without these two factors, it is not a high probability setup. All right, but this is not just the market breaking out, right? It's now changing the direction with power from a downtrend to an uptrend. All right, now then we add the 20 period moving average, right? And the 20 period moving average touches the low of the build up. All right, so what is also important is that this range here is happening at a key level. Here's why. This is not just any level, it is the level. Why? When you zoom out, you're gonna see this level lines up with a major support zone on the higher time frame. So what does this mean? This resistance is now turned into support. Price broke above, came back to test it, and it held strong there. So the smart money, the big money, they care about this level, right? The smart traders are not guessing, they are not random, right? They are waiting there. So when price reacts at a key level like this, it's not luck idea. This becomes a high probability zone where the market is making the decision, right? So now, on top of that, you see that the market is pushing against the key support level, right? So you don't buy the breakouts because price hit the support. You buy it when the price action shows that the market is likely to go upwards, right? So here you can see another breakout with a build up, right? And this range is at least 80 candles. So we have the sign of strength, right? Price is making also a series of what? Higher lows into the resistance level. So it's like it's higher lows into resistance level. So this is a clear breakout trade. Once the build up forms and price breaks above these highs. Right, so now another important factor is that the price has reached the key support level on the higher time frame, right? So now that makes the setup even stronger. So when you combine all this stuff together, this reversal from a downtrend heading into a higher time frame support with a range more than 80 candles plus a build-up that has higher highs that is touching the 20 period moving average, this is going to be a super high probability trade for this breakout to work. Good. Now, of course, all this doesn't need to happen together. When you have 1 or 2 or 3 coming it together, it's going to be a good trade. But when you have all this stuff coming together, you're going to get an amazing high probability trade. If you take 10 out of 10 such high probability breakout trades, I guarantee that you are going to be very profitable, because with such a tight stop loss just below the build-up and a potential big reward, you are going to be a very profitable profitable trader, because your risk to reward ratio is very good. You have a high probability winning trade, which means high win rate, big profits plus high win rate. Amazing. So this is the masterclass strategy for trading breakouts. Good. All right, now let's wrap it up. We have covered what? We have covered 3 common breakout mistakes. Number 1, which is chasing breakouts. So don't enter trades after a big price move. Boom. No. The market often needs a break or a pullback. All right, so that's number 1. Number 2, buying against the trend. No. Always trade with the trend. Don't buy in a downtrend. You don't sell in an uptrend. Okay? No. Number 3, breakout without a build-up. Right? For a good setup, always look for a build-up, which is like a consolidation, before you trade that breakout itself. Right? And now, to increase your win rate in trading the breakouts, we look for at least 80 candles in a range. The longer the market stays in that range, the stronger the breakout is going to be. And then you wait for the build-up. A tight consolidation that is near the breaking point, it gives you, first off, a very good stop loss placement for a great risk to reward ratio. Alright, and then to add on, you can add the 20 period moving average. You wait for price to touch the 20 period average lows before heading its way upwards. Alright, and then you consider the higher time frame. Right, a breakout at key higher time frame support or resistance level is going to massively increase your chance of success. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.